Hey everybody, JJ here. Welcome back to another Saturday of Zoom networking. I'm in Las Vegas. I am at the Clever Summit with Cody Sperber, Cole Hatter, Pace Morby, Jenna Hoover, Amy Majori, Jamil Damji, rock stars all over the friggin' place. And I'm building my business and I'm networking. And I lost my voice. You can tell I lost my voice, but you don't have to listen to me today because you're going to be listening to Brian Fine. You guys might know Brian. He's a rock star in real estate, brings value every time he gets in front of the microphone. I love this guy. You know, real estate's about relationships. And Brian is a friend of mine. Brian is family. I love this guy. Brian, how you doing, brother?
Doing fantastic, JJ. Glad to be here.
Hey, brother, it's always good to have you here. You know, I talk about to this group all the time about relationships, and you and I become friends, and I value that immensely. I love you to friggin' pieces. I just do. It's about relationships. But enough about you and me. Everybody knows we're good friends, and I'll take that to the bank every day. What are you going to be talking about to people today, Brian?
Today, we're going to look at the 2022 real estate market and how we're buying properties, even though there is no inventory. So we're going to take a look at the data, and then we're going to take a look at how we've changed our underwriting. It's very different than it was before COVID. Just the way we define a deal, the way we finance a deal, and the way we are holding property and using it to build wealth.
That's fantastic, brother. I know you bring excellent value. You've got a wealth of knowledge, and people want to hear you, not me. So I'm going to say, Brian, hey, brother, take it away.
All right, guys. So today we're going to talk a little bit about how we're underwriting cash flow deals in the 2022 real estate market. Since COVID, the game has changed. The way we were looking at investments to get returns on our real estate in 2019 is very, very different than how it is today. So let's dive into it. I'll give you plenty of data, plenty of ammo to back this up and explain our train of thought. And at the end, I will give you exactly how we are underwriting assets today. All right. So first up, who am I? My name is Brian Fine. I'm with the Coast to Coast Real Estate Group. That's our company. It's a couple of partners. We have a combined century of real estate experience. So we've been doing this for a minute. In 2021, we did a little over 30 million in transactions, and I'm pretty close to that already this year. So we'll do, depending on the inventory, we'll do 2 to 3 times that this year. We built a little over 420 unit portfolio in 18 months during COVID. And I employ a team of about 42 folks. That's a combination of W-2s and 1099. That's a full-blown management company. That's a construction company that does everything from maintenance to turnovers to full-on rehabs of apartment buildings and all that. So we have all that going on. Me specifically, I've been doing this for a decade. Started back in 2012, and I was a house flipper. We were buying them, fixing them, and selling them. Did about 100 retail transactions, and I am now reformed. I'm perfectly happy to not do that again. Now 100% focused on passive wealth. We define a bit of a difference in our parlance. We say that flipping houses and wholesaling and things like that, those are making money. But buy and hold, that's actually building wealth. I'm in business with my beautiful wife, Laura. And you can see our 2 boys there. Got a couple of pictures for you. And I have a passion for combative martial arts. That's the kind without the tournaments or the trophies, but lots of sharp objects and weapons and general fun like that. And I happen to also be a licensed manufacturer of firearms. So we like the things that go bang as well. So that's my hobbies. All right. So first, little disclaimer here to make the lawyers happy. This is for educational purposes only. I am not an economist, lawyer, CPA, financial planner, estate planner, insurance broker, therapist, doctor, auto mechanic, or life coach. Everything we talk about here is for educational purposes only. Make sure you consult with somebody licensed, insured, and professional before you go ahead and do all this stuff and ruin your life. But, you know, what the hell do I know? All right, so let's get right into the 2022 real estate market because this part will take a minute. So this is all hard data that comes from the Federal Reserve, National Association of Realtors, U.S. Census Bureau. So very, very solid locations to pull stuff, not random news articles. But I'm going to start with a little piece of news from a couple of months ago. The largest the largest landlord in America is Blackstone from Wall Street. They just bought another 12,000 apartments in mid-February for $5.8 billion. It is likely, by the way that Wall Street is behaving in COVID, that we on this call and you guys watching this video, we're probably the last generation of private real estate investors. 10 years from now, most of our hedge funds will have come into every major market and they'll bought us all out. That we're just simply making too much money for them to be able to tolerate it. They're going to need to take control. So they'll offer us buyouts to go away. So it is likely that we're it, guys. I'm not completely sure our children will have the opportunity to replicate the ways we're making money today. All right, so here's your first and most important piece of data for your 2022. I don't care what part of the country you're in. This is U.S. data across the entire United States. And you can see the last 5 years of inventory. You probably note a bit of a trend there. The active listings have been plummeting. They're in free fall. And it's a mathematical certainty that they're going to continue to drop and get lower. So if you think we have a hard time finding properties for sale now, just wait. It's going to get significantly worse over the next few years. And then the little chart below that, that's from the National Association of Realtors. They give a update every week. So the latest one I have here is from 4/9. So year over year in the United States, the median listing price is up 14.9%, while the amount of listings in the US is down by 12.3%, with 6 days less on market. So basically, these things are going in sub 2 weeks right now. Days on market down 15%. And then the one at the end there is more interested in the listing share. The price reduced. This is of all of the active listings, what percentage of them have a price reduction before they go under contract? It's only 14.5% that have seen that in the last week, and that makes up a total of 0.5% of all listings across the country. So very few properties where anybody is reducing the price at all. So few that it's almost a non-issue. From Goldman Sachs, 98% of all zip codes in the United States appreciated last year. So one of the big topics that are things that real estate investors have been saying since I started and probably long before it is location. Well, our current data basically says that you have a 98% chance of being in a location where the price will increase. So it's a little harder to get a bad location anymore. The 2% that aren't appreciating are either heavily rural or the very few Class D areas that are left in a metro area. All right, so a lot of you watching this video on this call, you guys are flipping houses and wholesaling and that kind of thing. You might find that it's a little difficult to find a deal today. So in addition to plummeting inventory, this is market conditions from the National Association of Realtors. So the bottom chart there, that's distressed sales from November 2015, November 2016. And you can see they were making up about 6 to 8% of all home sales in the United States were with distressed sellers. That's our target market if you're a house flipper. That's how we get that deep discount. We get them to give up quite a bit of equity so we can invest in that repair and then ultimately sell it and cash out that equity and get paid. Today, it's less than 1%. So if you're a house flipper, if you're a wholesaler, if you're trying to do creative financing, all that other stuff that requires a distressed seller as a baseline to get them to agree to that transaction, then you are 1/6 the market share that you were 5 years ago for 1/4 the available property. So it is approximately 24 times harder to get a deal today than it was in 2016. And that's straight by the numbers. So if you've been having a hard time, that may be a contributing factor as to why. It's not that these deals don't exist. I'm sure there's plenty of gurus standing on a stage somewhere in Vegas right now telling you that it's really easy to go ahead and get all these creative deals and buy things at deep discounts. These deals do exist. There's just a lot fewer of them. And while we're looking for those deals, we have to invest in the form of marketing expenses and time in order to be able to locate those assets. So it doesn't scale super well, especially in a market where everything is so tight. So if you've been having a hard time, this data may be a contributing factor as to why. It's also unlikely that this will be changing in the next 3 to 5 years, except to get worse. All right, and then let's look at, of the sales that are going on by price range, what share of the market do they make up? Most of our sub $250,000 properties, everything that would be, quote, affordable housing, is essentially gone. It's down almost 48% of what it was last year. What is for sale today, of the few properties that are up there, are basically above the $500,000 range. So we're looking at significantly more expensive properties. Those are usually not income producing properties, as in most markets, you can't sustain cash flow with those kind of purchase price. Where your 250 to 500K is probably your flat spot. That more or less hasn't changed in the last year. But if you are looking to flip or wholesale or anything like that, you are probably looking at the over 500K price point in most markets in order to be able to locate assets that will actually move. And again, this is straight data from the National Association of Realtors. I didn't make any of this up. In the meantime, how have the real estate prices been looking? Well, take a look at 2020 there. That little gray line, that is the COVID shutdown. That is the beginning of March. And that's considered a little mini recession. It's a real small one. And you notice that the line dropped. That was the approximately 90 days or so when the real estate market in the United States was essentially shut down. All the agents were told they couldn't sell anything. Lenders stopped lending. Title companies stopped titling. Like everything just stopped for a couple of months. And then like a very poorly built dam that burst. And take a look at that price increase ever since. And that trend is not changing. That is continuing to go up. So we've seen 15% year over year appreciation in 2020, 2021. And Goldman Sachs is calling for 15 to 20%, potentially 24% appreciation nationwide this year. And again, that's going to continue. It's even likely to accelerate in the next few years. So very, very high appreciation. If you go down to individual markets, individual metro areas, individual zip codes, there are pockets that are vastly higher than that. I just had an asset that we sold to one of our investors for $420,000 14 months ago. We just a 5-unit building, and we just comped it out yesterday at least $650. So, massive, massive appreciation, 40, 50, 60%. Certain metro areas are going up in the 30s pretty comfortably. So this is straight up across the entire US, which includes all the rural areas, which traditionally have lesser appreciation. So that we're maintaining this kind of a chart when you include everything is absolutely insane. So just something to keep in mind. If you think the prices are high now, just wait a week. They're just going up. So if you are actively investing, as in you are doing what the IRS considers dealing in real estate, that's wholesaling, rehabs, real estate listings, all that stuff. If you are selling assets at the end of the day, here's a little bit of math for you. So the average net profit on a rehab is about 15% pre-tax. Maybe you do a little better. Maybe you do a little worse, whatever, but 15% is normal nationwide. And after your taxes, depending on how much money you're making, 10 to 12%. If you're a really aggressive rehabber, it's half that. You'll be at 7.5% because you reach the top of the income tax bracket. Meanwhile, average market appreciation year over year is that same 15%. And like I said, in some markets, that is substantially higher. Once you sell a property, you're back at square one. We sold it, we collected our check. We're going to owe the IRS a check in exchange for that. But now we don't have anything anymore. We need to go locate a new asset. We need to rehab that. We need to wholesale it, whatever we're going to do with it in order to keep our business going and collect the next check. We call that the churn. Rehabbing, wholesaling, those are very high churn businesses, as in every deal doesn't get you closer to the next deal. It just gets you the next. It's just a deal. right? So you do it, you get paid, and then you go do it again. Rinse and repeat. It's a high-paying job. When we hold a property and those properties appreciate year over year, we're going to access that equity by cash out refinancing. And that, because it's debt, it's a loan, has no tax implications, right? When you borrow money from somebody, you don't owe taxes on it. In fact, the interest we pay them is a tax deduction for us and 1099 to them. When we refi, we also keep the property. It doesn't go anywhere. So let's put this in perspective for a second. Let's pretend I bought a rehab, or you bought a rehab. You bought it for 100, you put in 50, you're going to sell it for 250. It's a real profitable rehab, a ARV of $250,000. You're doing pretty good on that one. You're going to clear 100K minus gross, and you'll do a little less than that, probably 60, 70 when you're done paying all your holding costs and taxes. So that's great. Instead, the same day, I go buy the house across the street with the same floor plan that just doesn't need the rehab for $250,000. I put a tenant in there who pays just enough to cover the mortgage, taxes, insurance, nothing else. So I'm not making any money at all. I'm just not losing any. You sell your property in 6 months or so, you make your 70K and you're done, you're gone. I don't touch mine. And in a year, it's worth $45,000 more. A year after that, it's worth about 50 more. A year after that, another 50, 55, 60. And then I refinance it. And I pull out double to triple what you made without paying $1 in taxes. So it's just a little bit of a different way to approach it. We can still get the same big checks. We just get them a different way and on a different timeline. This is average home appreciation in the United States by state, just basically how much they all went up last year. My portfolio is primarily in Pittsburgh, Pennsylvania. You can see on the map there that means I made about 30K per door. To put that in perspective for you, according to this chart, last year, without doing a thing except owning the properties that we own, I made $12.6 million. If I was to have those properties appraised today and actually do a cash out refi on them, it's probably closer to 10. Not necessarily what this says, but still, that's a pretty healthy payday for, what did I do for this money again? Let me think. I held on to it and didn't sell it. All right, so here's your summary of the 2022 market and what you guys should be taking notes on and keeping in mind. The housing shortage, the zero supply that is going to drive up prices over and over again is going to continue for at least 5 to 7 years, but almost certainly going to continue to get worse for the next 3. Appreciation in the double digits are going to continue for that same time frame. Gary Keller, the owner of Keller Williams, the really, really big real estate brokerage, spoke at his big event to all the agents in, I think, February, and said at the current rate of new construction, it would be 18 years before the U.S. caught up with its current demand. So we're a little bit less pessimistic than that. I think it'll probably take closer to 10, but you have a significant supply demand difference, at least for the next several years. And at that 7 to 10 year mark, when everything evens out, it's not going to crash. Prices aren't going to suddenly go back to like 2006 or anything. Instead, it's just going to appreciate at a more historic rate. Instead of 15 to 20% appreciation, you guys are probably looking at closer to the 4, 5, 6% that we saw in most metro areas for the decade before COVID. All right, 2021, it went up about 15%, and we're calling for about 15 to 20% this year, and that is even with the mortgage rate increases. It's not enough. It's not going to cool the market off that much. Rents are going to increase the greater of either inflation or appreciation in any given market, but with a 12 to 24 month lag. That's because that's how long the leases are. So that's how long it takes to actually change the pricing. So we're only starting to see the actual rent increases based on the appreciation of 2020 now. So we're going to be looking at 15 to 30% rent increases year over year for the next couple of years. So very, very high income increases on these properties. And your taxes and insurance only go one direction, sky high. They're just going to keep going up. All right, so how are we underwriting to win today? To give you guys an idea of what I mean by that, I just showed you all the market data. There are no properties to buy. There's hardly anything out there at all. Despite that, currently at Coast to Coast, we are underwriting and buying 165 properties, most of them single family. So in a country where there's less than 400,000 properties for sale, we have like 165 of them. That's a pretty significant market share for a tiny little investment company in one city in the entire country, right? So how are we doing that? It's not because I'm spending $20, $30, $40,000 a month in marketing. It's not because we're knocking on doors every day. It's not because I'm posting thousands of times on Facebook that I buy houses. Ultimately, what we've done is altered our underwriting to be able to buy what the market has for sale. And it involves looking at your return on your investment differently. So here's how that mindset has to shift. In order to do what I do, you guys have to change your thinking. Most of you, by default, will think backwards from how we do. First, investors love to think, how low can I buy this? How cheap can I get this asset? I can make a fortune on it. We don't look at it that way. We don't think that way at all. Instead, I say, what can I finance? How much can I possibly pay for this asset? I'm looking for the high number, not the low one. It's all about the maximum. If I can pay your asking price, I'm thrilled to death. I want to pay it. If I can bid above, I want to bid above. I want to pay as much as possible for those assets. We maximize leverage in a highly inflationary environment with lots of just direct economic inflation, but also market appreciation. Leverage works for us, not against us. Minimum leverage I'm looking for in an acquisition is 75%. We go up to 105%. Whatever we can get away with leveraging, that's what we want to take. Maximum leverage on these assets. Cash flow is not for income. For those of you who've been looking at rental property before, or maybe already bought some pre-COVID, tattoo this one behind your eyelids. You are not looking for some dollar amount per door, some big check coming in every month, the day after you buy this thing. That's not what we're doing. The job of cash flow is to keep our holding costs at or below zero. It is to pay my mortgage, taxes, insurance, interest, management, and holdbacks for maintenance and vacancy. That's its job. If it makes me a couple of dollars after that, that's fine. We're just probably keeping them in reserve in case something goes wrong anyway. I am not looking for a check out of these assets. We're not going to get there. We're going to leave all that cash flow in those deals for at least 2 years, but probably closer to 5, at least until the first major refi. All right. Speaking of that, we talk about stabilization. That's a management term. When you buy a new property, that's the amount of time that it takes. Stabilization is the amount of time it takes to get it performing well. All the major repairs are done. All the tenants are paying and behaving themselves and not trashing the place. And it's just working like it's supposed to. We just round up and say that takes 24 months. We've done it the day after we bought the property. We've had it take 6 to 18 months, but we've never had it take longer than 2 years. So in our underwriting, we flat out assume it's going to take 24 months. And if you guys start doing that, you're not going to worry about, well, what if the tenant isn't good? Or what if it takes me 6 months to get it rent worthy? None of that matters. That's just stabilization. Assume stabilization takes 24 months. Construction is way too slow for most of our needs. So for you guys who love the Burr method, you are leaving a fortune on the table. You're basically pissing it away as far as I'm concerned. In markets that appreciate as fast as these ones are, you're talking about on the conservative side, the price increases by 1% a month. On the higher end, you're talking 3 or 4% a month, and that's not the unleveraged number, or that's the actual purchase price of the asset. So these things are going up thousands and thousands of dollars per month. So when we take these down, we can't afford to be waiting 6 months to be able to find them and buy them, because we need to be able to buy it at such a deep discount that we can afford to instantly do a cash out refi after equity improvement with a bank and get to infinite return. That's too slow. You'd only be buying 2 or 3 properties a year that way. In addition, I know a lot of you are in states that we consider tenant friendly. Those are immediately a hard pass. We don't buy properties in states where the state law allows tenants to not pay us and stay in our assets. So if you happen to live in one of those states, you'd have to remotely manage a renovation. So it's a rough game. So BRRRR method, while an extremely valid investment strategy, is far too slow to wealth build in a market like this. Right? Yeah, that's what I just said. The monthly appreciation outpaces all the rent. So think of it this way, guys. If you had a unit that rented for $2,000 a month, you're probably spending 80% of that in holding costs when you're paying your mortgage, taxes, insurance, and all your holdbacks. So you're making what, $400 on the high end? In the meantime, if that same asset was worth 200 grand and appreciated just 1%, I made 2K in equity that I'll access tax-free through a refinance in the exact same period of time. So in a market that appreciates this much, the cash flow is a joke compared to the appreciation. So use the cash flow for its job, to hold the property longer and for nothing. All right, with appreciation, you got two choices. You guys can either pay it or you can earn it. And if you want to earn it, you have to buy the property now. Every month you wait, somebody else earned it. All right, so all of that, those huge checks, that comes from holding the property. The faster you can acquire these things, the possession is 9/10 of the law. Get a hold of everything you can get your hands on. In fact, in some markets, you could almost afford to skip the tenant. You could buy the asset, not do anything to it, pay the additional holding cost out of your own pocket, and then sell it after a period of time, maybe a couple of years, for a substantial ROI. So take a look at your individual market data on that. Greedy investors don't get deals. If you can find a 10 cap rental property, you probably don't want it. That's a bit of a red flag to me in almost every location in the US at this point. So you need to reevaluate what you consider a valid deal. Our job as investors is to raise capital. That's what JJ says all the time. It's all about the relationship. It's all about the time we put in. We're doing that so we can find joint venture partners, business partners, and private lenders that will ultimately allow us to acquire more faster, so we can take advantage of this appreciation and make the inflation work for us instead of against us. We need to get on the right side of this wave of economic change. We can get crushed by it, or we can become very, very wealthy because of it. Your primary metric for all of you is the debt service coverage ratio, the DSCR. If you don't know what this is, it is calculated by dividing the net operating income, that's your gross rent minus your expenses, not including your mortgage payment, and then you divide it by your mortgage payment. So if I have a property that makes $1,000 a month after paying all its expenses, and the mortgage payment on that property is $1,000, 1,000 divided by 1,000 is 1.0. So a debt coverage ratio of 1.0 says that the property makes exactly as much as it costs. That is a cash flow neutral asset. When it comes to lenders, the majority of lenders today will finance as low as a 1.25 DSCR. Okay, so that means that the property makes 25% more net than its mortgage payment. So it's not a crazy amount of money, but that's as low as they'll let it go. If you guys are talking in terms of a cash on cash return using mortgage rates from April 23rd, 2022, you're probably looking at anywhere from a 3 to 6% cash on cash return. So these are very low compared to what we would have been buying in 2019. I'd be looking for cash on cash returns in the double digits. I'm looking for 10, 12, 14 cash on cash. Today, I'm thrilled to death with a 3 to 6. I'll buy it all day with a big smile on my face. Cap rates, that's a slightly different calculation. Those are probably in the 4 and topping out at about the 7 for any kind of asset, but specifically ignore every other metric and look at your debt service coverage ratio. That is what your lender is going to use to determine the maximum amount that they will finance on a income property. Okay, so that's what we're buying at today. We are seeing lenders drop this down. So with rates going up, the hard money crowd, they got ahead of it. So the Federal Reserve raised their rates, a quarter point or so. But in the minutes of their meeting, which you guys can all look up online, you can read them, They basically want to raise the rates a total of 1.75% in the next 3 years. So all your big secondary non-QM lenders jumped ahead of that. They pretty much universally agree that we're within 12 months of a recession. And they don't want to be sitting in a recession and way non-QM work, they sell the notes. They don't want to be holding a bunch of notes at lower interest rates than they're going to be dealing with when that hits. So they've just jumped the shark. They immediately went all the way up, and they're doing their long-term fixed products at anywhere from 6 to 8.25%. So they went up pretty quick. Our banks and credit unions, they're going to end up getting there too. They're just going to take a lot longer to do it. So we can still get cheaper money off of them for the time being, but they'll probably land in about the same place. And they're under pressure to keep doing deals. They need to keep lending their money. They get paid transactionally. They sell those notes for a return. So they don't want to suddenly stop lending. And in a market where all of the prices just keep going up, something's got to give. So if they both have to increase the amount they're loaning and the interest rate for that money in order to match the Fed, something else has to give. So what they're doing is lowering the required cash flow on the asset. So we've already seen quite a few non-QM lenders go down to 1.1. One of our favorite lenders that we do the majority of our financing through just went down to 1.2. So they've shifted down a little bit. And we do have lenders that will do a 0.9. We can fully finance negative cash flow at this point. Now, we aren't quite there yet where that's a requirement, but the way things are going, guys, it's probably coming. Since 2019, when we first started getting really heavy into our wealth building side of our business and paying attention to macroeconomic trends and microeconomic trends, we've been really good at reading the tea leaves on what the real estate industry is going to do. We've been very, very accurate on the way the prices are going to behave, the way the supply wasn't going to be able to keep up. We've seen all that coming. It's not a major surprise. Where we've been wrong, though, pretty much every time is how fast it happened. If you'd asked me in 2019 how long it would have taken to change from the market we were in there to what we are today, I'd have told you probably 2027. We'd have got to about where we are. COVID sped things up, and now it's a snowball effect. It's just going to happen faster and faster. These prices are going to continue to outpace how quickly we can raise the rent. And that's going to mean that we're going to continue to see thinner and thinner cash flow on acquisition. There's nothing wrong with that because we're making our money a little differently. But it does mean, I hope, I got my fingers crossed here, that we're going to be able to maintain decent acquisitions at 1.25 debt coverage ratio for the rest of the year. I don't know if we'll be able to do it. By Q1 next year, we are almost certainly at 1.1. And I don't know how long we'll be able to make it after that before we hit 1.0, and then we're buying cash flow negative. We are able to do it. I already figured out how to underwrite it. We're good to go. When the market reaches the point where negative cash flow is the standard, we will buy negative cash flow. We will keep playing. It's not going to change what we're doing at all. Just going to change our math a little bit. So that's the way it's going, guys. If you want the best deal on real estate, then you buy it today. If you'd like the deal to get progressively worse, just wait till tomorrow. And it's going to continue on that path indefinitely. So that is your underwriting for 2022. That's how we're buying stuff today. So that'll do for our call today. I hope you enjoyed the video. Don't forget to like and subscribe to Flip Side Up with JJ, and we'll see you on the next one.